In the silent, calculated world of global finance, there are moments of calm, and then there are moments that change everything. We're standing on the edge of one of those moments right now. It's a moment that feels both electric and unnervingly quiet, like the deep breath the world takes before a storm. For months, Bitcoin has felt like a coiled spring, wound tighter and tighter by forces beyond its control. It's shown incredible strength, rocketing to new all-time highs, but it's been held in check, caged by an invisible, powerful force. Remember, we are not financial advisors. The information provided by this channel is for information and entertainment purposes only. Be sure and do your own research before making any investment decisions. Now, that powerful force we are talking about has a name: the Federal Reserve. While the day-to-day market is filled with a deafening roar of noise, endless predictions, conflicting signals, and social media drama, there is one specific event, one clear announcement from the Fed that has the power to unleash the most violent, explosive, parabolic rally we have ever seen in the history of crypto. We're not talking about a minor price pump. We're talking about a fundamental shift in the financial universe. In the next few minutes, I'm going to pull back the curtain and show you the one specific announcement from the Federal Reserve that could be the single most powerful catalyst for Bitcoin this cycle. We're talking about the trigger that could send Bitcoin blasting past its recent highs into a new, uncharted phase of price discovery. This isn't some niche technical indicator or a fleeting narrative. This is the macroeconomic signal that the smartest, most patient money in the world is watching. And by the end of this video, you will know exactly what it is, why it matters so much, and how to prepare for the next big wave that follows. Forget the daily noise. This is the signal that changes the entire game. This feeling of being stuck in quicksand is made 1,000 times worse by the constant barrage of conflicting headlines. It's information warfare. One day, a respected on-chain analyst flashes a bearish signal, pointing to esoteric data that suggests a downturn. The next, a major institution like Bank of America says the setup for a massive rally remains compelling. We see headlines about significant ETF outflows on Tuesday, which perfectly explains why we can't seem to break resistance. Yet, on Wednesday, we're reminded that the year-to-date inflows are still massively positive, proving that long-term, deep-pocketed institutional demand is here to stay. The Crypto Fear and Greed Index captures this emotional roller coaster perfectly. It's been trying to claw its way out of extreme fear for what feels like an eternity, but it keeps getting knocked back down. It's stuck, just like the price. This tells us a critical story. While some optimism is trying to return, the market is still weighed down by a heavy, dark cloud that you can feel of negative sentiment. Confidence is fragile. This indecision creates a real, tangible sense of anxiety, like a great big, dark cloud. It's a pain point every crypto investor is feeling right now. You're caught in a classic dilemma: the fear of loss versus the fear of missing out, FOMO. Are you supposed to sell, terrified of a crash that could wipe out your gains? Or are you supposed to buy, terrified you'll be left on the sidelines watching the parabolic move everyone has been waiting for? The market feels like it's in a high-stakes poker game, waiting for one big player to show its hand and dictate the action for everyone else. And who is that player? It's the single largest player in the financial world, the one with the deepest pockets and the most power: the U.S. Federal Reserve. The frustrating price action we're seeing is a direct reflection of the market's deep uncertainty surrounding the Fed. We've seen it time and time again. A mere hint of a policy shift, a single phrase uttered in a press conference, can send the price soaring or tumbling. This proves one thing beyond a shadow of a doubt: the fate of this bull market rests squarely in the hands of the Federal Reserve, and their grip is maintained through two powerful and often misunderstood tools. To truly understand the rocket fuel, You first have to understand the launchpad's clamps. The Federal Reserve has spent the better part of the last 2 years building a financial cage for risk assets like Bitcoin. They've done this with two main tools: sky-high interest rates and a relentlessly restrictive policy known as quantitative tightening, or QT. First, let's demystify interest rates. Think of them as the gravity of the financial system. When rates are high, as they have been, gravity is incredibly strong. The Fed raises rates to fight inflation, which makes borrowing money more expensive and deliberately slows the economy down. But for investors, it does something else, something profoundly important. It makes safe, boring assets look really, really good. Why would a massive pension fund risk its capital in a volatile asset like Bitcoin when it can get a guaranteed risk-free return from a government bond? Imagine a powerful river. High interest rates are like a strong current pulling all the swimmers, capital, towards the safe, predictable shoreline, bonds. It's a rational choice that starves riskier assets out in the deep water of the fuel they need to rally. Crypto markets, and especially Bitcoin, thrive when money is cheap and abundant, when that current is weak and swimmers are encouraged to explore. The tight money policy we've seen puts a heavy lid on crypto's potential. Now, for the second tool, the one that works in the shadows, quantitative tightening, QT. If interest rates are gravity, QT is the act of actively sucking the air out of the room. Let's make this simple. After the 2008 crisis, and again in 2020, the Fed performed quantitative easing, or QE. Think of QE as the Fed turning on a giant fire hose and flooding the entire financial system with freshly created money. That new money has to go somewhere, and a lot of it found its way into stocks and, of course, crypto. The historic 2020 and 2021 bull run was heavily fueled by this QE-driven ocean of liquidity. Quantitative tightening is the exact painful opposite. With QT, the Fed doesn't just turn off the fire hose, it hooks it up to a powerful vacuum. It stops buying assets and lets its old holdings mature and expire, effectively pulling money out of the financial system. It shrinks liquidity and absolutely demolishes the appetite for risk. It's no coincidence that the brutal crypto winter of 2022 coincided perfectly with the beginning of the Fed's aggressive QT phase, alongside other major market shocks. History is crystal clear. QT is a massive headwind for Bitcoin. It creates an environment where capital is scarce and investors are scared. Now I'm going to get my steps in, and I'll meet you downstairs. This brings us to the heart of the problem. For nearly 2 years, we've been living in a high-rate QT world. The Fed's policies created a liquidity desert, and that's precisely why Bitcoin, despite its strong fundamentals and ETF approvals, has been struggling to break out and sustain a rally. It's not because the bull market is over, it's because the macro environment dictated entirely by the Fed is hostile. The big money investors, the institutional giants, are hesitant to go all in because they're afraid of what the central bank will do or say next. As more institutions have entered the crypto space, Bitcoin's correlation with traditional markets like the S&P 500 has grown. They often treat it like another high-risk tech stock. When the Fed tightens its grip and stocks fall, Bitcoin often falls with them, sometimes even harder. We can no longer afford to ignore the Fed. Their decisions are arguably the single most important variable for crypto today. But here's the crucial part. This entire regime of high rates and QT is coming to an end. The cage is starting to break, and there are clues everywhere if you know where to look. This is where things get truly exciting. To the untrained eye, the market is a chaotic mess of conflicting data. But if you're paying close attention, the Federal Reserve is leaving a trail of breadcrumbs, and they are all pointing in one direction: a massive, system-altering policy pivot. Let's connect the dots. The first big clue, the one that shook the bond market, was the announcement from the Fed's October 2025 meeting. They would officially end their quantitative tightening program starting December 1st, 2025. This is a game changer. Let's use our analogy. The vacuum sucking the air out of the room has been switched off. The pressure is no longer increasing. For risk assets like Bitcoin, this is the first real sign of life. Think of the Fed as the captain of a colossal supertanker. For 2 years, that tanker has been moving in one direction, tighter money. Ending QT is the captain finally cutting the engines. The ship is still drifting forward from its own momentum, but the force pushing it is gone. This is the first necessary step before the ship can even think about turning around. The second and more immediate clue is coming directly from the bond market itself. The CME FedWatch tool, which is a sophisticated instrument that tracks what the world's biggest traders are betting on the Fed's next move, has been screaming that a pivot is coming. As of early December 2025, traders were pricing in an overwhelmingly high probability, between 80% and 87%, of the Fed's very first rate cut at its December 10th meeting. These aren't just wild guesses. This is the collective, multi-trillion-dollar bet of the entire financial market. The data supports their bet. The Fed's favorite inflation metric, core PCE, has been cooling significantly, and the job market is finally showing signs of a slowdown. This gives the Fed the perfect justification to start cutting rates. Their battle is won. They've tamed inflation. Now, the new risk is slowing the economy down too much and causing a recession. The only logical next step is to ease up. The third clue is more forward-looking, but just as powerful. There's significant chatter in elite financial circles about a potential change in leadership at the Fed in early 2026. While this is currently just speculation, the very idea that a new chair could bring in a more dovish, pro-growth policy is a powerful psychological signal. The market is starting to price in not just a short-term pivot, but a long-term future where the Fed is friendlier to markets and more focused on lowering borrowing costs. This is an incredibly bullish long-term signal for hard assets like Bitcoin, which are designed to protect against currency debasement. So, what does this all mean when you put it together? Let's paint the picture. The QT machine that was pinning crypto down has been switched off. Inflation is falling, giving the Fed the green light to pivot. The market was now on high alert, expecting the first rate cut to happen any minute. And just over the horizon, there's the possibility of a Fed that is structurally more supportive of markets. The hurricane force headwinds are finally turning into powerful tailwinds. The cage isn't just unlocked, the door is creaking open. But just opening the door isn't the trigger. The trigger is the moment the Fed swings the door wide open and shouts to the world that it's safe to come out and run. Now, I'll be heading back to my desk and I'll meet you there. We've arrived at the core thesis. We've laid out the problem of the agonizing sideways market. We've identified the Federal Reserve as the villain holding things back. And we've connected the dots showing that a pivot is not just possible, but imminent. So what is the specific, explicit trigger that sends Bitcoin parabolic? It's not just a rate cut. We need to be very clear about this. It is the first dovish rate cut of a new, sustained easing cycle, backed by explicit forward guidance that confirms the Fed plans to keep cutting. Let's break down exactly why this is so much more powerful than a simple policy change. A single, one-off, hawkish cut, where the Fed cuts rates but simultaneously sounds cautious about the future, is not the trigger. We've seen that movie before. The market might pop for a day or two, but then it fizzles out as uncertainty remains. The trigger we are looking for is a total regime change. It's the moment they deliver that first quarter point or half point cut, and then, in the press conference that follows, the Fed chair's language completely flips. Instead of his dominant narrative being about fighting inflation, the narrative will pivot to supporting growth and ensuring maximum employment. He'll use phrases like easing financial conditions and being data-dependent in a way that signals a readiness to act again. And then comes the final confirmation, the dot plot. This is a chart released by the Fed that shows where each member anonymously thinks interest rates will be in the coming years. When that dot plot is released and it clearly shows a majority of members projecting multiple successive cuts for 2026, that is the moment the floodgates open. Why? Because it sends an unmistakable message to the biggest pools of capital in the world. The era of easy money is officially coming back. Here's how this single event unleashes the parabolic move. First, lower interest rates immediately make holding cash or bonds far less attractive. That safe, guaranteed return gets smaller and smaller, forcing giant funds to hunt for yield elsewhere. This is the portfolio rebalancing effect, and it massively benefits non-yielding scarce assets like Bitcoin. Second, borrowing costs go down across the entire economy, injecting a fresh wave of liquidity into the system. Think of it as that river current we talked about, not just slowing down, but reversing direction, pushing capital away from the safe shore and out into the deep water of risk assets. Historically, this increase in global liquidity has a direct, explosive, and positive impact on crypto. Third, and most importantly, this pivot triggers a massive psychological shift. It's a green light for the entire financial world. Big institutional funds, pension funds, endowments, sovereign wealth funds that have been sitting on the sidelines because of macro uncertainty are suddenly given the all clear. The main obstacle, the primary risk they were managing against, a hawkish Fed, is gone. We will see this reflected almost immediately in a dramatic reversal of ETF outflows and a surge of new, massive institutional money. Those net inflows we saw earlier in the year, that was just the appetizer. The main course begins when the Fed explicitly turns dovish. This creates a powerful, unstoppable feedback loop. The dovish cut in guidance make Bitcoin's price jump. That initial jump attracts momentum traders and breaks key technical levels. Renewed massive ETF inflows add relentless buying pressure. The media goes into a frenzy, covering the rally 24/7, which creates a tidal wave of FOMO for retail investors. This entire chain reaction is ignited by that one event, the first confirmed dovish pivot. In past cycles, we've seen Bitcoin rally significantly in the 30 to 60 days following the start of a Fed easing cycle. This isn't just a theory, it's a pattern based on how global liquidity and risk appetite work. The end of QT was the first step. The first dovish rate cut is the explosion. If you're getting value from this deep dive and are starting to see how all these global macroeconomic pieces fit together to create the perfect storm for Bitcoin, do me a favor and hit that subscribe button right now. We go deep on these crucial topics every single week to give you the strategic information you need to confidently navigate these markets. Don't miss what's coming next. Once that trigger is pulled, what happens next? What does a parabolic move actually look like? It's a term that gets thrown around a lot, but its true meaning is often misunderstood. First, we have to understand the sheer force of this liquidity shift. The end of QT and the start of a sustained rate cut cycle isn't a small change. It's a multi-trillion-dollar supertanker changing direction. This new global liquidity will be a massive tailwind for all risk assets. But Bitcoin, with its mathematically fixed supply and perfectly inelastic issuance schedule, is uniquely, exquisitely positioned to absorb this capital. The initial move will be fast and violent, as the market immediately begins to price in not just one cut, but a whole series of future cuts. We could see Bitcoin decisively and permanently break its previous all-time high. That price level has acted as a stubborn psychological resistance point, but a Fed-fueled rally is a different animal entirely. It's not driven by sentiment, it's driven by a fundamental shift in the global availability of money. Once that zone is cleared, the path to much higher prices, to true price discovery, opens up with astonishing speed. From there, the parabolic advance starts to take its signature shape. A parabolic move isn't a straight line up. It's an accelerating curve that appears to go more and more vertical on the chart. This is driven by that feedback loop we talked about, but amplified onto a global scale. As the price smashes through $100,000 and beyond, it generates its own hype cycle. Every major news outlet will be leading with Bitcoin's new record high. Institutional FOMO will hit a fever pitch. We're already seeing major players like Bank of America and other wirehouses begin to allow some advisors to recommend Bitcoin ETFs. When the Fed gives the official green light, those platforms transform from cautious gatekeepers into superhighways for a biblical wave of new capital. This is also when we'll see a dramatic shift within the broader crypto market. During these uncertain, choppy times, Bitcoin dominance naturally rises as capital flows to the relative safety of the king. We are in a Bitcoin season right now. But once Bitcoin establishes a strong, undeniable parabolic trend and begins to consolidate at much higher levels, that new, fast-moving capital will begin to cascade down into altcoins. This is the moment traders wait for. Past cycles have shown us that a true, explosive alt season almost always follows a major liquidity-driven Bitcoin rally. Bitcoin is the battering ram that breaks down the castle doors. Altcoins are the army that floods in right behind it. The move triggered by the Fed won't just be a short-term rally. It will redefine the market for the entire next cycle. It will finally and irrevocably solidify Bitcoin's status as a legitimate macro asset in the eyes of the world's biggest and most conservative financial institutions. It could also attract a new wave of interest from governments themselves, who might start seeing Bitcoin not just as a speculative gamble, but as a potential hedge against their own currency's inevitable debasement. The fact that the US government already holds a massive amount of seized Bitcoin, what some have called a de facto strategic reserve, already sets a fascinating precedent. A truly parabolic price move would force every central bank and finance minister on the planet to reevaluate their stance. The Fed's trigger doesn't just start a rally, it starts the next era of global adoption. So here's the bottom line. For months, we've watched Bitcoin, an asset built for this exact moment in history, get pinned down and suffocated by the Federal Reserve's tight money policies. This has created a market riddled with anxiety, frustration, and paralysis, leaving countless investors questioning their conviction. But beneath the surface, the pieces have been methodically falling into place. We connected the dots, the crucial end of quantitative tightening, the undeniable cooling of inflation, and the market's overwhelming expectation of a pivot. These are the clear, unambiguous clues that a major shift is no longer a question of if, but when. The revelation, the key takeaway from all of this, is that the ultimate trigger, the one event that will unleash a truly parabolic rally, is the first dovish rate cut that signals the start of a new, sustained easing cycle. It's the definitive green light from the world's most powerful financial institution, an announcement to the entire world that the liquidity taps are being turned back on. This single event will act as the catalyst, kickstarting a powerful feedback loop of institutional inflows, retail FOMO, and accelerating price action that has the potential to send Bitcoin into a new, uncharted phase of price discovery and global adoption. So, what should you be watching? Forget the daily chart wiggles, the influencer drama, and the noise. Focus on the Federal Reserve. Watch for the date of the next FOMC meeting. Listen with intent to the language used by the Fed chair in the press conference that follows. That will be the moment of truth. That will be the signal that the long, frustrating wait is over, and the next historic chapter for Bitcoin is about to begin. If this strategic, macro-focused view of the crypto market makes sense to you, and you want to stay ahead of these monumental shifts, make sure you're subscribed to the channel. The market is complex, but the underlying drivers are often simple if you know where to look. Hit that subscribe button and, just as importantly, click the notification bell so you don't miss the critical updates that are sure to come as we approach this monumental Fed decision point. Thank you for watching, and be sure and watch the next video here.